Does the run-up in NVIDIA's stock mean we're in an AI bubble? Well, to find out, I'm talking with Deepak Puri of Deutsche Bank. Deepak, welcome.
Great, thank you. Great to be with you, Andy.
Yeah, thanks for coming back.
Sure.
There's been this big run-up in AI stocks. Are we in a bubble right now?
Well, it's a great way to start the conversation. I would not call it a bubble, but it's definitely has gained a lot of momentum over the last 12, 15 months. I think the AI as a secular theme is here to stay. And the impact it can have on productivity is really something that the market has taken notice of. So, there's a lot of money sloshing around. There has been a lot of liquidity in the markets. And a lot of that is finding place in these secular themes, be it AI on the technology side or GLP-1, which is the obesity drug on the healthcare side. However, I would say that the market has started to distinguish between some of the underlying stocks that constitute the Max 7. Mentioned NVIDIA, but I think if you look at the earnings number from the fourth quarter, there has been slight diversion. There are some names within the Max 7 that are doing really well, but some others who are not making that much traction. So I think this year, 2024, might be the year of differentiation within the Max 7, whereby certain names do a lot better than the rest. And I think that might be the case for active management for this year, rather than being just passively invested in an ETF.
They're going to have to come up with a new name for the Mag 7. It's going to be what, the Fab 5, or go back to FANG?
It could be Mag 4, who knows? Yes, but yes, we love acronyms. The street loves acronyms, and I think we might need to come up with a new one.
Yeah, I mean, it helps, like, I think with like traditional investing or the consumer being like, I just do whatever the FANG one is. It's like a way of branding.
Indeed, but I would always, advocate for a much bigger and broader, market exposure rather than one particular theme or a segment or an industry for that matter, because, a lot of these stocks are so highly correlated, Andy, that one particular driver can bring one big name, and along with comes the rest of the names. So I think you need to diversify. What is interesting is if you look at the EPS growth from fourth quarter, S&P was up 8% year over year. This is the fourth quarter earnings growth. The Max 7 component was up 56%. So if you exclude the Max 7, the S&P earnings were actually down 2%. So our point is that maybe the broadening out effect needs to take place in the markets. And that usually happens when you're reaching all-time highs like we have been. So here you could lighten up some of the names in your portfolio on the Max 7 side and start looking at some of the other names, maybe in the healthcare side, maybe in industrials, materials, some of the commodity-driven cyclical names that have not really participated in this rally. And that would be one way to look at your equity exposure.
If NVIDIA's up, the market's up. NVIDIA is down, the market's down. It seems like we're in a perilous place right now as an economy, or maybe like a risk management mode. And so that might be the right thing to do, is just differentiating where we're buying.
Absolutely. And starting from a risk perspective is a better way to be invested in this market, or trying to start legging into this market if you haven't really participated till now, rather than just being overly exuberant about the return potential. Because whenever the markets are at such peak, we have 16 weeks out of the last 18 weeks, the market has gone up. We've just had fourth consecutive month of markets going up. It's not unusual for the markets to have 3 to 4 pullbacks of 5 to 7%, a correction of 10% in a given year. So, I think you might have a better entry point into especially the tech sector, later this year, rather than trying to just capture it at the peak.
We were talking about the bubble and the AI bubble. If it exists, we don't, what was it?
We don't really think there's a bubble yet. And one way of looking at it, a good measure, is what's called the PEG ratio, which is PE divided by the earnings growth. When you look at the PEG ratio of the tech sector, it's actually lower than the PEG ratio of the broader S&P. So if you think the tech sector is in a bubble, then you would have to assume that the entire S&P is at a bubble. And at 21 times earnings, I don't think so. Maybe it's a bit more expensive than what we have seen over the last 4 or 5 years. But the PE multiple for the S&P has, sort of graduated to a higher average than it used to be. Back in the day, 15 times earning was like the de facto standard to make a call whether it's cheap or expensive. I think that has moved upwards as the components of the S&P have shifted towards more digitization, more tech-oriented names. So I think now 18, 19 times is considered sort of the average, and we're trading at 21 times, it's not that bad. The other thing I would say, when you look at this particular rally, and let's say compared to the late 1990s, one thing that's different this time around seems to be the earnings backdrop. This is not, these price momentum or price increases is not happening just because of PE expansion. There's a very strong earnings momentum behind it. So I think that is a very different take compared to where we were in the dot-com bubble era.
Thank you so much, Deepak.
Pleasure. Thank you for having me.
Thanks for watching, and check out more at qz.com.